Welcome back to the SALT Sideline Report. I'm Leanna Haakons, and we are standing here at SALT New York with Barry Ritholtz.
Thanks for having me. This is my first conference in like 18 months. I think this is the first time I put on a tie in 2 years. It's kind of crazy.
It's very possible. I mean, this is a man that really needs little to no introduction. Blog father of the big picture, 250 million visitors over its time. The founder of Ritholtz Wealth Management, which has grown very quickly to a $2.5 billion RIA.
Depends where the market closes, but plus or minus, something like that, yeah.
So Barry, you are here at SALT New York this week. You were just moderating a panel on the comeback of hedge funds. Mm-hmm. What were your key takeaways from that, and why is that important as an RIA to talk about?
Clients always ask us questions. What about alternatives? What about hedge funds? What about this? And, my thinking about this has been, there's two ways to describe it. One is, half jokingly, come for the high fees, stay for the underperformance. And the reason I say that is there's 12,000 hedge funds, most of whom don't put up the numbers like the people I had on the panel today. If you're Steve Cohen of Point72 or Dimitri Balayasin or Mike Rockefeller of Woodbine, they've raised a lot of money. They've put up spectacular numbers. If you can get into those hedge funds, well, then by all means do. And there's probably, another 500 or so I could name that if you could get them to take your money in their main funds, not some, startup side pocket they're working on, but the fund that's put up persistent alpha throughout all sorts of markets, then by all means go ahead. The problem is, Point72 is mostly Steve's money. If you want to be in a Balayasin's fund, you need to show up with a giant check. You can't show up and say, I got $5 million, please take my money. It's all institutional. And the problem is, it's the old Groucho Marx joke. You don't want to be a member of any club that will have you. If they're willing to take your money, you probably don't want to give them your money.
So for our other RIAs or anyone that's looking to invest in the alternative space that doesn't necessarily have the name or the access that Ritholtz and your firm might have, what are some of the good options that they can look at? Or what are some of the key themes that you think in the alternative space are relatively good performers right now post-COVID world?
Sure. So you're looking for a couple of things. First, you're looking for non-correlated returns, which means you're getting benefits of diversification. If the stock market's down and something else is up or sideways, hey, that helps out a little bit. You don't feel like I got to do something and then you do something stupid. That's number one. Number two, you're looking to take advantage of the liquidity premium. If you have to lock up your money for 5 or 7 or even 10 years for some venture funds, there's a trade-off. Liquidity isn't free. And part of the trade-off of being able to get your money anytime you want is everybody else can get their money anytime they want. And we saw what happened in March of 2020. People panic. They sold the market off 34%. And some people succumbed to the temptation, oh my God, this is going to get much worse. Mm-hmm. And so they took their money out when they couldn't. Now compare that to an illiquid private equity fund, or you could buy farmland, or you could buy some venture fund. If you're stuck with it for 5 or 10 years, at least you're not going to shoot yourself in the foot. Doesn't mean the fund is going to outperform, but at least you're going to avoid the sort of behavioral mistakes that people do all too often in the equity markets. They let emotion, fear, and greed rule their decision-making, and look at how many people punted out in 08, 09 and never got back in, and it's a decade plus later.
I mean, yeah, and as a prominent RIA in New York and in the wealth management space in the US, your name is very well known. People were probably looking to you, other advisors, to see how you manage your clients, and you managed March of 2020 and 08, 09. What were your strategies around dealing with your clients last year during the beginning of the pandemic?
So I wrote a piece for Bloomberg at the end of March. I think it published April 1st, which always is fun because people get to tell you what an idiot you are, and this is an April Fool's joke. But the theme of the piece was, don't assume an externality like a pandemic is going to end the secular bull market. In the past, when we've seen things like this, Pearl Harbor, JFK assassination, 9/11, even 87 crash, what tends to happen is when some externality hits the market, it wobbles for a while and then it goes back to doing what it was doing previously. And I think time has bore that out. The market wobbled, fastest 30% drop on the way to 34%, and very fast recovery so from February to March 23rd, 25th, market dropped 34%. By August, it was back to where it started, which is why I always hate those 1 year chart. Look, the market's up 75% in a year. Well, go back 13 months and it's up 15%. It's not quite as, so you have to ignore that drop and bounce back. We were telling our clients we thought this had nothing to do with the economy, corporate revenue, earnings, that there would eventually be a vaccine and it'll get worse before it gets better, but it'll eventually get better. I think I put a tweet out that I was personally buying some stock some point late in March and said, this doesn't look like the way normal bull markets end. This is like a meteor that killed the dinosaurs, and I'm going to bet on the mammals. And that's kind of how we approached it, and I think it's worked out okay. I wish I would be as prescient as what comes next. I'm fond of pointing out none of us have any idea what happens, but at least with that event, it was pretty clear there were some historical parallels. When you get things from outside of the normal economy disrupting the economy, they tend to cause trouble, and then eventually they pass and we go back to the way it was. And pretty much what we've been enjoying the past year has been that ongoing, that plus $4 trillion in stimulus.
Of course.
Hard to bet. That's the other thing is people complain about deficit spending and the Fed at zero, and that's just stimulative to the market. And I don't know why you wouldn't want to be on the other side of that bet than complaining about it.
Yeah. So the use of historical data and in other, not necessarily health pandemics, but other issues that have happened in the past and in the markets have been able to help steer the client conversations to the right way, where your clients were not selling out of the market last March and through to the summer.
Well, you could use these historical analogies as, hey, we can't tell you what's going to happen, but here's what's happened in the past, and that can guide us a little bit in how we think about it. And the way we think about it is when it's not a recession caused by the economy. Obviously, when the government orders everybody to stay home and not go to work and not do anything, of course you can have a terrible recession. But it's not the normal economic cycle, and you have to distinguish between those two.
Now, I have one last question for you. Very simply, maybe not. What's your favorite area of alternative investing right now, and what excites you? Something new, maybe.
So I'm going to give you two. I'm going to give you a boring one.
Okay.
I'm going to give you an exciting one. The boring space in alternatives, it used to be bonds gave you a decent yield. They kind of have filtered away. And then we started looking at municipal bonds. So you got the after-tax yields, and now that's compressed. When I look at certain types of real estate like farmland's really interesting alternative to bonds. It's not volatile. You have that same liquidity premium we were talking about. Your money's going to be locked up for a long period of time. But I think reasonably priced farmland should throw off 4.5%, 5%, the way muni bonds used to. And so that's the boring conservative one. The exciting one, the interesting one is there's so much capital sloshing around. We're in the midst of a Cambrian explosion of new technologies, new ideas, new companies, new apps, new startups. It's hard not to be enthusiastic about not just big tech like Tesla and Google and Apple and Netflix, but the startup world. And so whether you're looking at venture capital or seed funding, that's a really exciting area. Same caveats apply. Hey, listen, I would love to give a ton of money to Andreessen Horowitz. They're oversubscribed 10x. You can't just show up and say, here's $500 million. So you have to be a little selective. You have to do your research. You have to think very carefully. And you also have to understand when you're going into the speculative end of the market, and what's more speculative than a startup, you have to assume that money is going to just light it on fire. It's going to disappear. Hey, if it works out, fantastic, but don't put more money into that space than you're willing to see be used for kindling, because that is a non-zero possibility. That could happen. I'm really excited about what's going on in technology, but I'm very well aware of the fact that most startups don't make it. We all have survivorship bias. For every Google we see, there are how many search engines? There was like 100 search engines. Most of them are there's like a half a dozen left. Most of them are gone. That's true in every space you can look at. So there'll be crypto winners and losers. There'll be app winners and losers. There'll be, just look what's going on in biotech. It's just bonkers time of human history to be an investor. I'm sure there's some sort of correction out there coming, maybe even a crash eventually. But like the 99-2000 crash, on the other side of it, we're going to see a lot of really interesting innovation. It's very exciting.
Well, we love having your insights, and thank you so much for joining us on the Sideline Report. Appreciate your comments as always.
My pleasure. Thanks for having me.
Thanks, Barry.